Welcome back to Passive Income Pilots, everyone. Tait Duryea here in studio
In studio.
with Ryan Gibson. How you doing, man?
Good to see you. We're here and we're broadcasting live from Seattle, Washington.
That's right. Beautiful sunny day. Just kidding.
The weather's been pretty good here this summer, and so far in October, we've had a little bit of a slow start to our rainy season. Spider season right now. All the spiders are out, and then it's going to get dark and wet for the rest of the year. But we're overlooking Lake Union right now, and we're watching seaplanes take off from Kenmore Air. And so our new office right here on Westlake Avenue North, here in Seattle, you know where the Lake Union building is. We're actually in the Union Bay building now, which is right across the street.
Getting the new studio built out. If you're watching this on YouTube, we got a nice desk, a couple of microphones. It's coming together, so it's only going to get better from here.
Yeah, and Tait and I are together. Tait's on a layover, and we're having a good time here. And we're going to talk about today's episode.
Yeah, and that was on purpose. I picked up this trip just to be in studio today. It's amazing. So check this out. If you haven't heard of a cost segregation study, most people haven't. If you're not listening to this show, usually you haven't heard of it, which is bizarre because it is a engineering tool to unlock incredible amounts of depreciation on your real estate. It can save you a lot of money in taxes.
Yeah, and you might be thinking, hey, didn't you guys record somebody like a bunch of episodes ago? But we've had a ton of questions from our Passive Income Pilots Facebook private forum. Specifically, Joshua and Carlos asked a couple questions. So we're going to get into that later on in the show. We're going to answer your questions more directly and more head on. But this is a great reminder. If you have a question and you want to ask us, you can go to ask@passiveincomepilots.com. You can email us that way, or you can go through our website, passiveincomepilots.com, or you go join our Facebook group.
Yeah. Facebook group is almost 1,000 pilots strong now.
Yeah. 1,000 aviators that are focused on investing. And it's become a very collaborative group. So thanks for joining. And let's talk a little bit more about our guest today.
Yeah. Erik Oliver, Vice President, National Account of the Cost Segregation Authority. This is a huge national cost segregation firm, can do cost segs in any of the 50 states. So definitely check them out. Let's get straight to the show. This was super interesting.
Let's get to it.
Welcome to Passive Income Pilots, where pilots upgrade their money. This is the definitive source for personal finance and investment tactics for aviators. We interview world-renowned experts and share these lessons with the flying community. So if you're ready for practical knowledge and insights, let's roll.
Hey, Erik, it's great to have you on the show. It's so much fun meeting you at a conference and then bringing you onto the podcast to share your knowledge with our listeners on all things cost segregation. So, Erik, why don't you just give us a little background about yourself?
Yeah, thanks for having me. I'm glad to be here. So my background is, go back to the college days. I was in college, didn't know what I wanted to do when I grew up, but math had always come somewhat easy. Couldn't write a paper to save my life. Never liked the sciences, but math came easy for me, luckily. So it was either a finance or accounting degree. I ended up in accounting. Like most people who graduate with accounting degrees, I'd never pursued my CPA. It was just went into business development, and my business development job took me to the East Coast for a number of years. I was born and raised in Salt Lake City, Utah. Once I got out of college, that business development career took me to Virginia for a number of years, then New York. Looking to move back west, and didn't know what I wanted to do. I had some business development background. I had accounting degree, and came across something called cost segregation. And to be honest with you, Ryan, I didn't know what cost segregation was at the time. Before I interviewed for the job, I knew it had to do with accounting. And so I was halfway there, but didn't know exactly what it was. So got online, started looking at YouTube videos. I had dabbled in some real estate myself. Once I realized what cost segregation was, I was very intrigued about the job opportunity. And so I applied for the job. That job brought me out here about 8 years ago with a company called Cost Segregation Authority. Been doing cost segregation studies ever since. Have loved it. It's been a great career, and been able to use some of my background to help investors reduce tax liabilities. So far I've really enjoyed it.
That's fantastic. Well, can you break down what a cost segregation study is? And maybe the way that we get to that is to talk about how we depreciate real estate, what depreciation is, how we depreciate real estate, so we can kind of set the stage, and then we can talk about what a cost segregation is and what that can unlock for you as a different way to depreciate that real estate.
Yeah, so depreciation is just the IRS or the government allows us to take an expense. It's a non-cash expense every year on our real estate. So if you think about a building, the material within that building deteriorates every year. And so that building, in theory, is worth less or has less value. Now, we know that's not always true. Real estate tends to go up in value, but the building itself, the material becomes dilapidated over time. And so the government or the IRS allows us to take this depreciation expense. Again, it's a non-cash expense. For residential units, it's depreciated over 39 years. For commercial units, it's depreciated over 39 years. Residential units, it's 27 and a half. So just to make the math easy, let's say you've got an office condo that you paid $390,000 for. Essentially, you're going to get a $10,000 write-off every year for the next 39 years. I've oversimplified that a little bit. Land is non-depreciable, so you always have to back out the land value. But the idea is you're taking this standard deduction or 1/39th of a deduction every year until that property is fully depreciated. That's called straight line depreciation. That's what a lot of investors do. They get a closing statement. They buy a building for $390,000. They give that closing statement to their tax preparer, and they enter it in as a 39-year asset. The challenge with that, or the problem with that, is I may not own my building for 39 years, and I want my deductions a lot faster than that if I can. And so the way we can legally do that is through a cost segregation study where we go in and identify these short-term assets. So when you buy an office condo, or let's say you buy a residential rental or a short-term rental, you're not just buying the land and the walls, you're also buying some cabinets, some countertops, a retaining wall, a fence, a driveway. All those items I mentioned, the IRS says should be depreciated over a shorter useful life than 39 years or 27 and a half. The challenge is that when we give that closing statement to our tax preparer, most tax preparers don't have the knowledge to be able to go into that asset and say, okay, you paid 390 for this short-term rental. What is the driveway worth? Well, they don't know if the driveway is 4 inches of concrete or 6 inches of concrete, let alone what the value of that would be worth. And so a cost segregation study, just as the name implies, is we go in and segregate the cost of the building into different buckets that allows you to front load or take the depreciation at a much faster rate. And again, there's time value of money, there's inflation. A dollar today is worth way more than a dollar 39 years from now. So give me my deductions now versus letting the IRS hold on to these. And so that's kind of what we're doing when we're looking at cost segregation is we're just front loading or taking the deductions at a much faster rate.
And it's my understanding that the IRS looks at this as the correct way to depreciate real estate, right?
Yeah, no, that's true.
Straight line depreciation, you're like, hey, we don't care if you want to do that. We'll give you less tax breaks, sure. But they actually look at breaking out all of the different components into their proper depreciation categories, into their proper depreciation schedules is the correct way to do it. Because they know that a refrigerator isn't going to last 27 and a half years in a rental house, right?
Yeah.
And a roof isn't going to last 39 years on a commercial property.
No, you hit it on the head. There's actually a book, it's a couple thousand pages thick, where the IRS basically lists everything that can be depreciated and tells you what category it should go in. But again, for so many years, people would buy a building with all this stuff in it, and there was no way to break it out. We knew that the carpet wasn't going to last 39 years, but who was going to be able to come in here and tell us what, of my $1 million purchase price, the carpet was worth $82,754. And so that's where engineering firms came together. There was a court case, testing my history here. I think it was in 94 or 97 with Hospital Corporation of America. They're a big healthcare company out of Tennessee. They got multiple hospitals through the mid-Atlantic area, but they had some pretty savvy tax accountants who said, hey, we've got all this linoleum flooring in our hospitals. Why are we depreciating this linoleum flooring over 39 years? And so they broke it out and they came up with a methodology to break it out. And everything they broke out in that court case, the IRS said, hey, wait, why do you have all these deductions? What's going on here? It ended up in the highest tax court. But when it was all said and done, they won on just about 95% of the stuff that they had segregated out. And the IRS says, yeah, you're right. In our guide, we say that linoleum flooring is a 5-year asset. So you're not doing anything wrong by depreciating that linoleum flooring over 5 years. And so that's kind of where it was started from.
Let's break this down to be a little bit more practical. So $390,000 house, you're going to depreciate $10,000 per year in straight line for 39 years. That's great. So you're saying I'm going to get a $10,000 tax break automatically for doing nothing, just straight line depreciation.
Well, let me just clarify tax deduction. So that's not tax deduction. It comes off of your taxable income, but a $10,000 tax deduction is probably worth, for a high income earner at 37% tax bracket, that's a $3,700 tax savings. Yeah.
Yeah. And if I make $10,000 in profit, that would offset that profit, right?
Yep, exactly.
Perfect. And so by breaking it up in these buckets, I think what you're trying to say is it might not be 10,000, it might be 20,000 or 30,000.
Yeah, it could really add up quickly. So Just to give you an example on a 300, let's use that example, $390,000 Airbnb for say. So normally that gets depreciated over 39. Airbnbs are a little bit interesting because some people think of it as a residential rental, but in fact, the IRS actually looks at it more like a hotel. So as long as the average stay is less than 7 days, it's more of a transient use than it is a long-term rental. And so most oftentimes, short-term rentals are depreciated over 39 years. So if you have a $390,000 short-term rental, you're going to be looking at, we usually segregate on rental homes somewhere around 30%. So you're looking at somewhere around 120, 115 to $120,000 of short-term assets. So we're going to go in and say, okay, the appliances are worth 12, the cabinets are worth 20, and all that stuff added together is going to be around 115 to $120,000. Now that 120,000 now gets to be depreciated over either 5 years for some of it, 7 years for some of it, or 15 years for some of it. So now instead of depreciating it over 39, we're taking those buckets of money and depreciating it at a faster rate. And so your $10,000 deduction you would get using straight line could essentially be a $70 or $80,000 deduction by segregating and putting them in the correct asset lives. And then there's something else that we may get into called bonus depreciation, which kind of puts cost segregation on steroids and allows you to take it at even a faster rate.
Yeah, I was just trying to get down to like the edge, like the business case, right? So if you're thinking about doing this or not doing this, straight line will get you 10K. Maybe, this accelerated depreciation would, cost segregation study might bump that up, right? To $20,000, $30,000 a year. And when you're thinking, what is the so what? You nailed it. If you're in that 37% tax bracket, now you're making about $3,700. You're getting $3,700 in tax savings potentially per year. And then when you're evaluating the cost of maybe what one of these studies would be, Eric, what would you say? I mean, we're not going to hold you to the exact amount of this, is being listened to, 5 years from now or whatever.
Right.
But about what would you say? I mean, that $390,000 property, what can I expect to pay? Give us a ballpark.
Yeah. Yeah. No, ballpark. So usually on any single family rental, short term rental under about 5,000 square feet, you're probably somewhere $2,800 to $3,200. For some of the real larger residentials, it might be 35, 36. But and then you get into commercial properties, it can be as much as 20,000 for a large office complex with multiple buildings. But for most of your short term rentals, your residential rentals, you're somewhere in that 28 to $3,200 range.
Yeah. So if you're evaluating, is this worth it? Let me think about this, right? Do some quick math. Always consult with your tax, legal, and investment advisor on this kind of stuff. But, at the same time, this might be just a no brainer, right? Where if you pay a little bit, now you're going to get that instant tax. You're going to get that credited basically back into your taxes right away.
What I wanted to touch on here was, Eric, you're going to give an example of a short-term rental that you bought that you ran a cost segregation study on. If you're a listener to this show, you've heard my story about the Reno Airbnb that we put into service last year. We did a cost segregation on that. We got, I believe, $140,000 write-off.
Nice.
And regardless of real estate professional status, because it's a short-term rental, you're able to write that off against your W-2. I'm going to say that again. If it's a short-term rental and you buy an Airbnb and the average length of stay is less than 7 days and you spend at least 100 hours managing it in the current calendar year, then that depreciation loss can offset your W-2. So if you're making $500,000 a year as an airline pilot, you should be listening very closely to this strategy because you're in the highest tax bracket, and every one of those dollars that you deduct is good for 37.
Yeah.
Or if you're in a high state income tax state, could be even upwards of 50% on the dollar.
Yeah, that's incredible. Yeah, so I just think that it's worth exploring this and at least having a conversation. By the way, can somebody just call you and just talk to you about their situation? How does that work, Eric? Are you kind of available for that?
Yeah, no, we always will do what we call a free benefit analysis. So we don't ever want to engage somebody to work with us if they're not going to save significant tax dollars. We want to make sure that the savings is well worth what they're going to pay for us to do the study. And so we'll get on the phone, we'll ask some questions, we'll get some information on the property, we'll run an analysis to say, here's what we can expect conservatively should you do a cost seg study. Here's what our fee would be. And then we always advise them to check with their tax preparers to make sure that they can in fact use the deductions, versus active versus passive. But yeah, it can save significant dollars, for the right person. So
Let's talk about the downsides. Are there any downsides to this?
You know, there's not. So it's not for everybody. As Tate mentioned, that we do have active versus passive income limitations. So if you're not a real estate professional, then you may be limited to how much of a deduction you can take. So paying us to create a big, huge deduction, if you can't use it, doesn't create any tax savings. But what Tate was referring to is the short-term rental loophole. I even hate to use the word term loophole because it sounds like we're doing something nefarious, but we're not. It's actually in the tax code. And if you go back to what I said earlier, these short-term rentals are treated more like hotels. And so what Tate was getting at is you basically are running and managing actively a hotel business. So I'm a W-2 earner. I had a tax liability at the end of 2022. I knew I was going to owe a bunch of taxes come 2022 tax filing time. And so it was just about October. And I said, honey, we got to do something. My wife she's in the school district. So she's a W-2 employee. I'm a W-2 employee. I have some long-term rentals that I have, but if I do cost seg studies on those long-term rentals, those deductions from those long-term rentals can only be used to offset the income from those long-term rentals or what is considered passive income. So that wasn't going to help me out because my income was all from my W-2 job and my wife's W-2 job. So we actually just stumbled across a short-term rental at a lake town near us. And we went and put 80,000 down on that property. I spent 100 hours, as Tate mentioned, from October through December. You have to spend 100 hours and more time than anybody else. So I strategically bought it at the end of the year because I knew I needed to spend more time than the cleaner, more time than the maintenance folks. So I bought it at the end of the year. It took me well over 100 hours to furnish the place and get it ready to go. Then I did my cost seg study. It's interesting. You said yours was 140,000, Tate. Mine was right at 140,000 as well. So I got a $140,000 deduction. Come the following year, 2023, I hired a management company. I no longer had to manage the property myself because I got my deduction in the year that I did manage it. So it was considered an active deduction. And I was able to use that to offset $140,000 of my active income. So if you're in a 37% tax bracket, I got to get the calculator for this, but 140,000 times a 37% tax bracket, that's $51,000 in tax savings.
Yeah.
And I put 80,000 down on this property. So of my 80,000 down payment, I got 51,000 back. And I've got a revenue generating property now that spits off income. The area I got it in, I wasn't so worried about the cash flow. I get a little bit of cash flow. It's a seasonal summer property. It does more than break even. I get a little cash flow, but I was in it for the appreciation and I was in it for the tax savings. I was going to send a $80,000 check to the government. Instead, I got 51,000 of that back. So
Yeah, absolutely.
And if you tie together episode 78 with Casey Roloff and the Seabrook investment, right?
That's right.
Just connecting dots here.
Yep.
That was actually in an opportunity zone. So you could buy a new build in an opportunity zone. So if you had gains from other investments, you could take the $51,000 tax break plus any gains that you made from other investments, from sale of business, sale of stock, sale of real estate, and you could completely wipe out your. So there's a lot of layering that goes on here, right? And then, we have another episode where we talk about life insurance strategies, right? So you'd be leveraging that money to put the money down that you do buy, and then you get all these tax credits and savings and things like that. So
We had an episode talking about ways to access cash, 401k loan. It's like there's a lot of ways that you could borrow. You could borrow money from a HELOC from a property you already own,
right.
roll it into an Airbnb, take a massive tax deduction, and I always say the government is subsidizing your down payments on these things.
They actually, they are, especially with the bonus depreciation. Like I said, it just puts cost segregation on steroids. And so these benefits can be huge. And I look at it like you said, I'm either giving this money to the IRS and God knows what they're going to do with it, or I'm creating hopefully long-term wealth. I mean, this property will appreciate over time. And I got it for a small down payment. It cost me 30,000 down, but I saved, close to 51,000 in taxes.
Amazing.
It's a no-brainer. So if you've got high W-2 income, and I found this too, we work with a lot of, high W-2 doctors, lawyers, pilots, on this strategy. And a lot of them have second homes anyways. Now, second home, now there is some clarification between a second home and a short-term rental. You can only spend, technically it's 14 days at the property, but turning your second home, if you start renting that out as a short-term rental and you manage it, all of a sudden you might have some significant tax benefits. So a lot of us are already doing it anyways. And so it's just something to look into with your tax preparer.
Let's unpack that a little bit. So like if you had a second home that you purchased in say 2020 and now it's 2024 and you want to convert that to a short-term rental, can you retroactively go back and do anything, or how would that work? How would that nuance play in? If I'm sitting here thinking, "Oh yeah, I've got that second home and I want to do this and I want to convert it into a short-term rental." Like what does that look like in this scenario?
Yeah, so you can convert it into a short-term rental and you do get to take depreciation on it. The one it's not really a downside. The one factor to consider is your starting basis is not what it's worth when you turn it into a short-term rental. It's what it's worth or what you paid for it back in 2020.
Right.
So that would be your starting basis. Your in-service date would be the date that it became available for its intended use or purpose as a rental. And then you may or may not get bonus depreciation on it depending on when you originally bought it. If you bought it in 2012, when there was no bonus, you wouldn't get bonus on it. But if you bought it in 2021 and didn't put it into rental until 2023 or 4, you may be eligible for bonus. So yeah, we see a lot of people doing that. Um, Again, you just got to be careful because the IRS will look at intent. It always comes down to intent, and it's up to you to substantiate your intent. So if you, I mean, some people try and get real tricky. I got to be honest. They'll call us and be like, okay, I've got this. I'm a doctor. I've got this short term rental. I've got this second home up in Tahoe. If I list it on Airbnb for the month of December and then take it off, can I get all those deductions? And the answer is like, yes, you can. However, if you're ever audited, they're going to throw it all out and you're going to owe the IRS money. So their IRS is looking at intent. And so
Yeah.
just be careful. Always consult with your tax preparer. I know we've mentioned that a couple times, but it's important to make sure everyone's on board and everyone understands the risk that's involved. But there's not a lot of risk. If you're going about it the right way, if you're buying short-term rentals and you're managing short-term rentals, there's court cases where you just have to document it, document your time, make sure you're keeping logs. And, I don't mind keeping a log of 100 hours if I'm going to save $51,000 in taxes. I'll do that all day long. So,
Yeah. And yeah, that's great that you were able to write off more than your down payment on the house. We were a little bit lopsided. I think we put down 180 on a $729,000 purchase, but I mean, $142,000 off my W-2. I mean, it's just
yeah.
unbelievable. All right, let's touch on bonus depreciation. Can you unpack the entire thing for us from start to
So just to clarify real quick, we haven't talked about bonus depreciation at all. So all this short-term cost seg study stuff has nothing to do with bonus depreciation.
right?
This is a new subject that we're introducing into the conversation.
Correct.
Yeah.
Yep. Great point. So, bonus depreciation is a tool that the government uses to stimulate the economy. So, it's been around for a number of years, and the government will get together and say, okay, the economy's not doing well. We want people to go out and buy stuff. So, we're going to incentivize them by giving them bonus depreciation. So, they would be anywhere from 20%, 30%, 50%, all the way up to 100% bonus depreciation. And what that means is if you were to buy an asset, I'm going to use a bulldozer for an example. Buy $1 million bulldozer. It had to meet a certain criteria to be eligible for bonus. One, it had to be brand new. I couldn't buy a used bulldozer. The government wanted me to go out and stimulate manufacturing and all that. So they made me go buy a brand new bulldozer. And that bulldozer had to have a useful life of 20 years or less. And I think that's interesting because I don't think that the IRS intended for bonus depreciation to be used in real estate because remember, real estate's 27 and a half or 39 years. So that was pre 2017. So brand new property, brand new equipment, had to have a useful life of 20 years or less. And at the time in 2017, you were eligible for 50% bonus. So if you bought $1 million bulldozer, you would get to take 500,000 of depreciation or 50% in year one. The other 50% would get spread out over the useful life of the bulldozer. Fast forward to the end of 2017 with the Tax Cuts and Jobs Act, Donald Trump was our president. Donald Trump owned real estate, and Donald Trump was very favorable to real estate investors when he revised the tax code. And they made a couple changes. One is it went from 50% bonus to 100% bonus. So any assets that you bought between 9/27 of 17 and 12/31 of 2022 were eligible for 100% bonus. So if I went out and bought a bulldozer for $1 million, I got to take $1 million write-off in year one. Now, that was the first big change. The second big change was they added 5 words to the tax code that I think made a huge difference. They added the words new to you, the taxpayer. I think that might actually be 6 words. New to you, the
Do
taxpayer,
you
I
the
think.
taxpayer?
I told you English was not, I don't know, is taxpayer one word? English was not my forte.
Oh
Ask me a
yeah.
math problem, I can help you, but English was not my forte. So, anyways, they added 5 or 6 words to the tax code that said basically new to you, the taxpayer. So now I don't have to go buy a brand new bulldozer. I can go buy a used bulldozer. That's new to me, the taxpayer, and all of a sudden I get bonus. So I don't know how many of your listeners are buying bulldozers. So let's flip this to real estate and see how this applies to real estate. But essentially, if you go buy a piece of real estate, so you buy a short-term rental in 2019, falls within that 100% window. You buy it in 2019, and let's say you buy it for 400,000. And let's say we determine the land is worth 100,000, so you have to back out the land. So you have 300,000 of depreciable basis. When you tie bonus depreciation and cost seg together, remember we segregate around 30% of that 300,000 into short life assets. Assets that have a useful life of 20 years or less. Remember, it's 5, 7, and 15. So of that $300,000 building, we're going to find $100,000 worth of stuff that can be segregated. And now that $100,000 worth of stuff, you get 100% bonus depreciation on that stuff. So
Bingo.
instead of depreciating that over 5, 7, and 15 years, you get to take 100% of it all in year one. So you're getting the whole $100,000 deduction in year one. Now, bonus depreciation is starting to phase out. So as I mentioned, anything bought between 9/27 of 17 and 12/31 of 2022 was eligible for 100%. Anything bought in 2023 was 80%. Anything here in 2024 is 60%. Next year, it's 40%. In saying that, the government has, there was a bill introduced at the beginning of this year to extend the 100% bonus through 2026. It passed the House almost unanimously, with bipartisan support. It got to the Senate, and there was a few senators that are like, you know what? We're in a presidential election year. We're not going to pass any tax stuff this year. It's going to look good for Biden. We don't want to do that. So we're going to stall this bill. We're going to wait till after the presidential election. In my opinion, regardless of who wins the presidential election, Congress will get back together after this election and they will put together a comprehensive tax bill that most likely will extend the 100% bonus. The reason I say that is one, everyone in Washington owns real estate. So regardless of whether they tell you they like it or not, they all like bonus depreciation. And two, that bonus depreciation is also tied to the expiration of the child tax credits. And those child tax credits those two things are tied together. So the Democrats are going to say, hey, give us the child tax credit. We'll give you the bonus depreciation. Let's get this thing passed. And so my guess is that both of those will get passed. If that does happen, I think that the 100% bonus will get passed through 2026.
Well, you heard it. You heard it here first.
That was a really good explanation because we were tracking that bill. That actually held up some of our K-1s
Yeah.
because operators were saying, hey, we don't want to have to redo everything. We're just going to delay a couple of months till this bill passes. It's going to be great. There's going to be 100% bonus depreciation again. And nope.
Yeah, we were hoping it would pass. It's interesting the way they pass these tax laws because remember, tax filing for next year starts in February. And so the tax software companies need time to get these updates into their software. So my guess is January, they'll put together the bill. They'll have it passed by early February. That gives them time to update the software so that by the time we start doing our taxes next year, I'm hoping that we'll have 100% bonus. But hell, even 60% bonus is,
Oh, it's
we were
fantastic.
doing cost egg. Remember, cost egg and bonus are separate, like Ryan stated.
Right.
It's way better to depreciate something over 5 years versus 39 years. But when you add bonus, that 5-year stuff gets a 60% bump, an 80% bump, in some cases, 100% bump. It just puts it on steroids and makes it even more impactful.
Yeah, I always say bonus depreciation is the gasoline on the fire. I mean, it's
Yes.
like, yeah, cost segregation is already a good idea. It's going to accelerate, over the next 5 years, over the next 7 years, over the next 15 years, you're going to be taking more depreciation every year on your assets. But you throw bonus depreciation in there and it's just like, boom, that year one is just so good. And just to clarify, if it doesn't pass 2026, it'll go to 20% and then it's gone in 27. We'll be at 0% bonus.
Yeah, phases out completely in 27. So 20% each year.
So now let's talk about the retroactive stuff because we touched on it very, very briefly right there in your example. But if I own a rental property that I bought, let's say in 2018, and I had no idea about bonus depreciation. I had no idea what was in the Tax Cut and Jobs Act. I got a little surprise coming my way, right?
Yeah, well, Eric gave us a window. What was the window?
So if you bought it between 9/27 of 17 and 12/31 of 2022.
17 until the very end,
Of
last day
2022.
of 2022.
If you're in that window, this applies to you. Pay attention.
Yeah. Ding, ding, ding.
Go for it. Yeah, sorry, you were saying.
Yep.
I bought that rental.
No, that was great. So it's based on the date it's purchased and put in service, right?
Yeah, it's based on the date that it goes in service. So let's say you bought something in 19, didn't do a cost seg study. You've been taking your standard deduction for the last 4 or 5 years. You can actually do cost segregation on your 2024 tax return, take all that missed depreciation that you could have got over the last 4 or 5 years and drop it on your current return.
Bam.
It does require an additional form. It's called a 3115. It's interesting. It's called a change in accounting method, but you're telling the IRS, hey, I'm changing the way I'm accounting for my property. Instead of using straight line depreciation, I'm using accelerated depreciation. And you actually check a box on that form that says, I'm going from an impermissible method of depreciation to a permissible method. Like you were going to Tait, you're doing it wrong. You're telling the IRS, hey, I depreciated my carpet wrong. I was depreciating my carpet over 39 years. I should have depreciated over 5. And here's the difference in that number. And the nice thing is you don't have to go back and amend any tax returns. You get to take that deduction in the current year, which is great, without amending.
And what's so cool is because the property was placed into service within that 100% bonus window, you talk to Eric, you get your cost segregation study done, and it's applicable for 100% bonus
Yes.
depreciation, even though the current year, we're recording this in 2024, we are at 60%. So if
Correct.
you were to place a property in service today or sometime in this calendar year, that cost segregation study would only be eligible for 60% bonus depreciation because you placed your property in service somewhere between September 27th, 2017 and New Year's Eve of 22. You get to take the entire value of that dollar amount that comes out on that cost segregation study.
Yeah, and just to kind of make this is tying the question to the scenario we're talking about. In our Passive Income Pilots Facebook page, if you're not part of this, you can join Passive Income Pilots, fill out some information, you get into the private group. There was a question on October 1st from Carlos. He asked, bonus depreciation scenario question. If I buy a property, live in it for a little while, and then fast forward a year or so, and now move, and that said property gets converted to a STR, short-term rental, can you bonus depreciate the short-term rental against your own income if you're actively managing it, even though you purchased the home the previous year as a primary residence? So basically, taking a primary, flipping it to a short-term rental, and applying bonus.
As long as that primary was bought during a bonus period. So yes, in that case, yes, he could. Had he bought that property prior to September 27th, then no, you wouldn't be able to take bonus on that.
But you could still cost seg it.
You could still cost seg it. Yeah, we'd still recommend cost segging it, but you wouldn't be eligible for a bonus. So there are some unique laws around having stuff as a primary residence. So definitely check with your tax preparer first. But yes, in most cases, you can apply bonus depreciation.
So Carlos, if you're listening to this, thanks for asking the question, and get in touch with Eric. He
Yes.
probably has some good news for you.
Yeah.
I have a couple other questions from the forum, and maybe we just go ahead and just ask a couple of these questions and just make sure that we're nailing this down. How is in service defined by the IRS? Does it have to be listed on Airbnb or VRBO? I'm considering putting the property into service for a short time to realize accelerated depreciation prior to the renovation and cost seg.
That's a good question. So the definition the IRS puts forth is available for its intended use or purpose. Now, I've seen that interpreted by 50 different CPAs, 50 different ways. Some people will say the day you close on it, it's available for its intended use or purpose. Some people will say the day you rent it out, it's available. I've heard people say the day you list it. So my recommendation would be if you buy an old dilapidated property that you can't rent in its current condition, then its in-service date is not the day you buy it. It's the day that you finish your renovations and it's available to be rented. I don't necessarily think that it has to be on VRBO. I just think that if you've got pictures and you can show that that property was in that condition on that date, it was available, then I think that you're good to go. you build a much stronger case. Obviously, if you have it listed, you build even a stronger case. If you've got some money coming in off of it, you can obviously easily show that it's in service. But when you get down to the end of the year, in the example I use, I bought my property in November. By the time we got it set up, I only had 3 renters or 3 short-term stays in there. Time we got it set it up through the end of the year, but I listed it as in service because I was using it for its intended use or purpose. And so
Yeah.
I don't think there's a certain amount of time you have to have or a certain amount of renters, but you definitely want to document it, have pictures. If you've got a listing, that just makes your case that much stronger.
So from my experience, and I've explored this a lot. Technically, it's from everything that I've gathered, it's that it's advertised for use. So if it's listed on Airbnb, now pro tip: take a screenshot. Got some feedback from episode 77. We're going to be posting this in the Facebook group. Some really wise things that someone learned during a tax audit. They had listed a property, but they never took a screenshot of their Craigslist ad. So because somebody didn't actually rent it in that calendar year, but it was listed, had they had a screenshot of the advertisement that they had posted, the IRS would have allowed the deduction.
And the
Yeah.
follow-on question Joshua also had on the forum was, can my LLC rent the property to my family at fair market value, trying to stay under the 7-day STR loophole in 2024? So can they run it? They can run it out effectively to anybody, right, Eric?
Yeah, I don't want to misspeak on that because I don't know for sure. Check with your tax preparer. That's my canned answer, but I don't see why that would be a problem. I mean, how do I say this without saying it? I don't know how the IRS keeps track of how many days you're using it personally.
Well, it sounds like he's renting it out. He's renting it out to his family.
And in that case, you're right. He's actually paying rent. He's paying himself rent. So I don't see it as a problem. I think where you become a problem is where you call it a short-term rental and you've got 2 people staying in it all year long. That's
Yeah,
and
yeah.
then you're using it, you're staying there all summer and going to the lake all summer. That's hard to justify.
Right.
Yeah.
And so I think that's where you become a problem. But if you the technical, you're not supposed to use it for more than 14 days of personal use. Otherwise, it becomes a second residence and not a investment property. But again, I think that's tough for the IRS to prove how often it's being used. As long as you've got income coming in from the property throughout the year, in most cases, you're pretty safe.
Yeah, and we in episode 77, we talked to Luke Lyson, who is in the aircraft leaseback space. And one thing that he said is, the rental goes into an LLC. And the LLC, if you want to actually rent your own airplane, for example, you would have to just rent it just like anybody would from your LLC as an individual to the LLC. So I would imagine that applies the same. And again, it's always worth checking with your tax and legal professional on this kind of stuff. Don't, do your own due diligence here.
Yeah, I would think that the answer that you're gaining from that question should be coming from the guy that or gal that's going to go into a food fight with the
Yeah,
IRS during the
totally.
audit.
Yes. They're the ones. That's why I was saying, whoever's signing your return, make sure they're okay with it because they're the ones that are going to defend you.
Yeah.
Yeah.
Great advice.
So the other question we have from the forum, we're kind of cleaning up here. And Joshua, thank you for asking your question. In episode 44, Tait mentioned a cost segregation study for depreciation. He also mentioned that he had actively managed the STR property for the year to realize its full potential. Is that calendar year, or if they buy it late in 2024, do they just need to actively manage the property inside of December 31st, 2024, and then hire somebody else potentially in 2025? How is that? How does that looked at?
Yeah. So again, it's going to come down to intent. If you were to buy and close out on the 30th, you get a renter in there on the 31st, you say you managed it for 2 days and then you kicked it over to a management company, that's going to be tough to defend to the IRS. I personally bought and managed my property for 3 months. I bought it in October, managed it before I turned it over to the management company. And I think that's justified. Hey, I had time this year. I thought I was going to be able to manage it. It was a lot harder than I thought. So for 2023, we decided to get a management company. I think but technically it's just in the tax year. You have to manage it in that tax year because if you're managing it in that tax year, when you do those taxes, those deductions become active for that tax year. So it's not a calendar year. You don't have to do it for a full 12 months, but you just have to do it in that tax year.
And for us, we bought in October as well, but it took us until after Christmas to get the first renter in there because it took that long to get the furniture. And I mean, it was a big house. We had to deck the whole thing out to get it ready to be rented. So, and keep in mind, you got to spend that 100 hours. So it's hard to spend 100 hours in
2
2
days.
days.
Actually, I think if my math is correct, it's technically impossible to do 100 hours.
I think it's technically impossible. Yes.
Eric, this might not be a question that you know the answer to, so we'll let you off the hook here. But someone's asking, like, what kind of expense should somebody? I mean, you talked about how much the cost seg study costs, right?
Sure.
It depends on how big the house is in your scenario, but you gave us a range, so thank you for that. And we won't hold you to it. But what about preparing taxes? If you're doing this type of cost segregation study, is this something you can do in TurboTax, or is this something that you're paying a big fancy CPA for, and there's more kind of hidden cost to doing this, right? You're going to have to pay, now a more advanced CPA. They're going to charge you for this work. How does that kind of connectivity work between this type of transaction?
No, that's a great question because we see the whole gamut. We work with people, we do cost seg studies, and then I get a call. Actually, today we're recording this on October 15th, which is the tax filing. I've got my phone on silent, but I'm sure I'm going to have messages of, hey, I did this cost seg study. How the hell do I enter this into TurboTax? So that's a great question. So you don't have to have a fancy CPA to be able to take advantage of cost segregation. I will tell you this from personal experience, and I will tell you this from working in this industry. People leave a lot of money on the table by trying to skip over that step of hiring a CPA. And I'm not just saying this because I've got a lot of CPA friends in the industry. I'm saying this because I've seen it happen way too often. So yes, if you take the study that we provide and you go into Walmart to H&R Block and you hand them the study, they're not going to know what the hell to do with it. And you're going to have to call us and we'll walk them through, and we're happy to do that and we can make it happen. But there is a huge difference, Ryan and Tait, between a tax preparer and a tax strategist. A tax preparer takes your facts, they takes your W-2, your forms, they run them through their system and it spits out a number. And they say, this is how much you owe or this is how much you're getting back. A tax strategist will sit down and say, hey, have you done a cost seg study? Have you done the hours? Have you documented your hours so that if this ever gets audited, which the chances of it getting audited are very slim, but we want to make sure we're covering all of our bases there. And they will find deductions for you. And it does cost money. But I'll tell you what, we have people call us all the time who are like, hey, I just heard about you, Eric, on a podcast. I just heard about cost seg on a podcast. I just filed my 2023 taxes. I just wrote a check for 80 grand, but I've got these 7 properties I've owned for the last 4 years. Can we do something? And had they been working with a CPA who understands real estate, who understands investment properties, they would have already been doing that. And so, yeah, it would have cost them. It's not going to cost them $195 like it does at H&R Block to file their tax return. It might cost them $500 or $600, maybe even $1,000 to get their taxes done. But in that scenario where they paid $80,000 to the IRS and we were able to get them all of that money back, I mean, it's very little compared to what the potential savings would be. So I don't have an exact answer, Ryan, on what you should be paying to get your taxes done. But as you build a portfolio of properties, even if it's one property, and I will say for most of your listeners, if they're doing one short-term rental property and they're trying to take advantage of this short-term rental loophole, there is a lot that goes into that your typical tax preparer is not going to know. They got to make sure it's set up correctly. They got to make sure it's documented correctly. They got to make sure that these numbers are showing up on the right schedules. And so one little mistake could get all of this thrown out. And so I would say, if you inherit a property, your parents pass away, you inherit one single property, you're probably okay doing your own taxes. But as you start to get into some of these more, I don't want to call them complicated because I think that scares people away. They're not that complicated. You just have to have the right team around you. But as you start to get into some more of these tax strategy type situations, you've got to have somebody who understands real estate. And so there's a lot of good CPAs out there who are real estate focused, and it makes all the difference in the world. And they're worth every dollar. They're going to charge you a little bit more, but I promise you it's worth every dollar.
And you don't have to go far to look for that. You can go right into the Passive Income Pilots Rolodex.
Yep.
Go back to episode 75, Unlocking Tax Savings, Real Estate Strategies for High-Income Pilots. And we interview a CPA that is familiar with this strategy and who has been vetted by us and is actually, I think, we give a little discount or whatever if you say you're from Passive Income Pilots. So
yeah,
you have these people in your Rolodex now as a listener, right? You can go to Eric for your cost seg. You can go to episode 75 and learn from Brandon Hall and Hall CPA, the real estate CPA, talk about this tax savings. All these things are available. This is why we have this show, so that you guys don't have to go finding the right, we've already met all these people and done all these things and worked in the industry, right?
Yeah.
And so we're just connecting our listeners to the right people to help have a great, tax, legal, and investing, framework. So
Yeah. Have a good bench.
you got to have a good bench. So when we always say, oh, check with your CPA, tax advisor, blah, 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 we are bringing on those people, and, you can do your due diligence on them and you can decide who you want to use. But we try to bring those types of people to the forefront so you can actually build your team and have these folks to go to when you need to. So
Absolutely. Yeah, I can tell you, I pay a lot more than $1,000 a year to file my taxes.
yes, me too. And me too. $1,000 sounds really nice.
Yeah, that sounds really nice. But hey, if it costs you 10 grand and it saves you $10,001 from the IRS, that service was free.
Exactly.
That's the way I look at it. And it's usually not that close.
Yeah.
It's wildly in the other direction.
Absolutely. So Eric, I really appreciate you coming on the show. How can listeners get in touch with you to take the next steps on a potential cost seg study?
That's a great question. So I think we talked about earlier, Ryan, we've got the link. If you want to put that link in the show notes, listeners, if you guys click on that link, we'll do a free benefit analysis for any of the listeners. If you've got properties and you're paying taxes, it doesn't hurt to get the benefit analysis run. It's no cost to you. We'll give you an idea conservatively of your tax savings as well as what our fee would be. And then we can get on the phone with your tax preparer, or you can forward our information to your tax preparer, and we want to confirm that it does or doesn't make sense. If you guys want to get a free benefit analysis, you can go to the link in the show notes. That link is just www.costsegaauthority.com/passive income pilots. If you click on that link, again, it'll be in the show notes. We'll give that free benefit analysis so that you guys can get an idea of which of your properties are good candidates, which ones may not be good candidates, but at least you'll have the information to see if there's some potential tax savings that you might be leaving on the table.
And if you're looking for an Airbnb this year and you want to send the Zillow link over, I'm sure you take a look at that as well. You can look at what the benefit would be. Honestly, this is the most no-brainer tax strategy.
If you're going to buy property, you might as well.
Yeah.
And maybe Eric could offer you something like, hey, why don't you just do this little tweak and then you can take the depreciation, right? So
yeah, no, we're happy to consult any way we can.
Yeah. If you're listening to the show and you want to buy property, think about it. You want to get a preliminary on your title. You want to get an insurance quote. You want to get a cost seg study quote. You want to get all these things kind of lined up so that you can pencil what this property is really going to do for you overall holistically, right? So take the time to do a free consultation. It's no sweat, right? So,
and if you put a property in service between 17 and 22, congratulations.
Yeah, go back. You just found a little gem here. So Eric can hook you up with that as well. Well, everybody, that's all the time we have for today. Thanks for listening. Catch you on the next show.